Welcome to Asset Yield, the podcast series of Kinsstellar's Asset Solutions sector, where we speak with principal investors, advisors, and funders in the world of non-performing and non-core assets of all classes, bringing you frontline market insights in real time. We're here this afternoon with Gustav Hultgren, who is the co-founder and partner of Laub Capital. Delighted you could join us. Gustav, where are you these days during our various degrees of lockdown?
Hey, Denise. Thanks for having me. I'm in Spain, south of Spain. You know, all the things have been very crazy, of course, in Spain. Here in this region, we've been quite fortunate relative to other regions in the country. From this week, they've started with a gradual reopen that if everything works out, we should be in the new normal, as they call it, by 1st of July. It's looking better.
Okay. Gustav, you and I have worked together for quite a number of years in various iterations. I think that you and I could fill a Rolodex together. But maybe you could tell our audience a bit about your background and then kind of lead up to what you're doing these days with Laub Capital.
Yeah, absolutely. I usually say that I'm a banker, which actually now I've been working more in the NPL industry than in the banking industry, but that's my origins, if you will. I left the financial industry and went to Ukraine, where I created a debt collection company in 2007. Then I exited that and joined a Swiss company called DDM, that is a pure financial investor in NPLs. Across Central Eastern Europe. In 2013 as CEO, we took the company public and grew it quite substantially. And then I left DDM essentially to set up a Laub Capital together with a very old friend of mine called Tobias Thunander, who's also Swedish. And Tobias brings very relevant experience with him since his days within banking, where he was working with structured finance, and then lately as part of the portfolio solutions group at KPMG, where he was head of debt advisory for about 10 years. We have been talking to a lot of investors, of course, in order to raise money, and the reception has been very good. And we are now ready and funded to start doing our first transactions in order to build our track record and continue expanding our funding from there.
With your background, I mean, any banker who goes to Ukraine already has a very thick skin and has a great frontier feeling about this. So for sure, you're seeing some opportunities in Corona. It's not all down.
No, of course not. We see this as a quite significant catalyst on the supply side, of course, in the NPL market. I think it's important, though, to point out we're focusing on the entire Eastern and Central European market, not maybe Ukraine so specifically at this stage. I think it's clear for everybody that bank losses are going to mushroom on the back of Corona in most all countries. And as I said, supply of non-performing loans for sale will certainly be in abundance in the coming periods.
What is Laub's mandate? What kind of investments are you looking at?
The mandate is pretty broad, so we can do anything that is, broadly speaking, distressed assets. And in Central Eastern Europe, I mean, actually it's geared so that it's European mandate, but our core markets are clearly Central Eastern Europe, and that's where we focus. But also we have a keen interest in the Mediterranean countries. So basically you could say Portugal to Greece, Greece to Estonia, if that makes sense.
Wow, that's quite a geographical breadth.
I think the importance of this here is our operational model, where we distinguish ourselves quite a lot from other investors that are fully integrated, meaning that they invest in portfolios and have their own workout. That means that you're marrying yourself to a market and you have to be basically a repeat buyer there to support your organization. But the operational model that we have, where we act as pure investors, and we source the workout capacity locally, means that we can have a very much larger encatchment area and work across multiple markets. And then on the portfolios that we do invest in, you sort of create an ecosystem for that singular investment. Otherwise, of course, it would be very difficult to build up a collection servicing capacity in all the markets that we're looking at. That would be a massive undertaking, of course.
Sure, sure. You use the word collection, which obviously ties back to NPL portfolios and your
Yeah.
background, of course, in debt servicing. Are you focusing primarily on NPLs, or are you diversifying your asset classes? For instance, would you look at corporate turnaround? Would you look at energy assets, strict real estate, REOs, for instance?
REOs, certainly. Corporate turnarounds is something that we, both me and Tobias, have ample experience from. So it's certainly something that we could do. That said, of course, now in the beginning, given that we're a limited organization, I think we're primarily interested in looking at portfolios of claims where we can, process this together with our workout partners or debt collection agencies that we operate together with.
And are you agnostic about the portfolios? Must they be secured, or are you also looking at unsecured?
That doesn't matter for us. I think returns and safety in numbers, meaning that we have solid possibilities to do accurate forecasting for the portfolios, so that we in turn can go back and evidence to our investors that we can deliver on the forecast that we present to them effectively. That's a very most important thing of everything here. I think given the volatility in markets, you need to be able to show reliability and predictability in the business model that you operate. Otherwise, it's not the time for selling dreams to people.
Absolutely not, although we could use some these days. As a fellow traveler in Central and Eastern Europe and Southeastern Europe, we both have worked in the same region for quite a number of years. I think we can agree that post-2008 financial crisis portfolio business was coming to a sort of, I don't know if the word is close, but it was contracting over the last few years. The markets in Central and Eastern Europe are intrinsically relatively shallow, and the big portfolios had already been sold, and we were coming down to sort of final portfolios. Is that something that you would agree with, or do you see the market pre-corona? I think we call it BC and PC.
Yeah.
In BC, how did you see the market until February of 2020?
No, of course. I think your analysis there pre-corona is very accurate. Of course, the large NPL levels that we saw in many markets had, of course, contracted quite significantly. As you say, there was a lot of sales going on. But I think here the importance is that for banks, it takes quite a while until you have a client who stops making payments regularly, until the bank will terminate it and then initiate a process for selling this claim onwards. Many of the banks in Central Eastern Europe, losses that effectively occurred, say, around 2010 weren't sold until 5, 6, 7 years later. There's a couple of drivers why things will be different this time. The monitoring authorities in the different countries will be much faster to go in and start doing analysis. I don't think they will be as lenient as they were last time, because the last thing that anyone wants at this point is for a crisis that is now happening in the real economy to also move into the financial industry. So I think that the banks will have will be under the magnifying glass from the authorities and the regulators, meaning that they will come to market and try to sell these portfolios much, much faster than they did in the last round.
You raise a really good point there, Gustav. I mean, there's a kind of dynamic, or let's say tension, between the regulators acting very quickly now. I think that certainly we're seeing a lot more proactivity from the central banks and governments than we did in 2008, particularly with the spate of emergency measures that have been passed, enforcement, moratoria, payment deferrals, and so on. But on the other hand, as you correctly point out, lesson learned from 2008, in general, it takes some time for these losses to crystallize, wouldn't you say?
They do, but it's also very tightly interlinked with the accounting treatment in the banks. And there's been quite a lot of regulatory change in the past years, where banks now are forced to account for predicted future losses already in their balance sheet from day one, effectively. And this, of course, means that for the banks, it becomes expensive to hold the NPLs on their books much earlier than it was in the past. Me and Tobias, we talk a lot about front book and back book issues here in the market. I think there's a couple of things here that we will have a front book, meaning new supply that the banks will come out and sell. That's just, it's going to increase tremendously. It will take a couple of months, of course, maybe a few quarters until that filters through, but it's coming, and we see the banks already now are keeping a very close eye on credit losses, and there's a lot more focus from everybody because they knew how bad things turned in many markets after the financial crisis, with banks stopped lending to businesses, that sort of hampered economic growth, etc. The other thing that we have at the moment, which is an issue, is the back book, and that is for the investors that already have bought portfolios from banks. Where I think if you put it down a forecast for a portfolio in fourth quarter of 2019, and now all of a sudden you're having a quarter, maybe 2 or 3 quarters where you're actually not getting any of the income that you had projected for, that becomes a very big headache for many of these investors. And we see a lot of the listed entities are trading down significantly as well in the share prices.
That's a very interesting point, the current asset management, and how are your colleagues, your competitors, your fellow travelers in the market, how are they managing their assets when they cannot enforce, when they can't collect, when there's basically, depending on the jurisdiction, a 3 to 6 to perhaps even 9-month moratorium? What do you see happening there besides accounting management?
The only really visible data that you have is, of course, the few listed companies here in Europe and maybe in some other markets. And they're, of course, the Q1 reporting is coming out now. Elections are down, etc. On the other hand, we should not forget here that many of these companies, they had maybe a 3-week impact from Corona in the Q1 results. In the second quarter, we're going to have a full quarter worth of Corona adjusted collections, if you will, in many markets. And it's going to look awful, bluntly speaking. Obviously, all of these companies will have to adjust their forecast, to the best of their ability. Of course, they have very limited visibility, as everybody else knows, when things will open up fully again and what's the new normal and all of this. But I think that they will, of course, need to adjust the values on the balance sheets, and this can hurt those companies. That's clear. When it comes to the large multinational investment funds that we also see on our market that are very big investors, I mean, in Spain here, for example, where you have a couple of investors that have invested billions of euros, there it's less transparent given that they don't publicly report anything. Their strategies are also, I would say, maybe co-joined with type of private equity approach, where they buy entire banks, for example, and then they split out the NPLs in one bucket and the bank in something else, where they have maybe an operational turnaround. They might be easier for them to manage this in certain aspects, but as I said, it's very difficult to know exactly what's going on there.
Well, it's interesting because you mentioned when you described Laub Capital, you are alluding to it when you discuss the big players in the market, the concept of diversification where they have multi-businesses. I'm very interested what's happening in the market right now and in many areas around the non-performing asset market. Your former colleagues, DDM, have just bought 10% of Addiko Bank. One of the major players, I think we can say their names, one of the major Polish-based, although across Central and Eastern Europe, Kruk, have bought Wanga.com in Poland last year. So in a way, there is a certain vertical integration. They're both doing the servicing, investing in the distressed assets and servicing them, but also originating. How do you view that whole market? And is this something that Laub would be looking to do as well?
Not at this stage. I don't think that neither DDM nor Kruk has communicated what the strategic intent of these investments are. There's obviously 2 things that come to mind. One, as you said, is that you can, the long way around.
You can create your own NPLs.
Yeah, which is kind of a very unholy alliance, which I don't know how the regulators would look at that. But I know that there are people, long further back in history that have created sort of non-bank entities for refinancing people that became non-performing debtors, if you will. with various degrees of success. I think the other thing maybe that this could be down the road is that they want to lean or use these banks to attract cheap funding. Maybe that's, of course, the other thing that might be obvious here. And I think that when it comes to using a bank as a funding vehicle, we've seen that with, we have Hoist in Sweden, for example, that is a big investor in NPLs, and they also have a banking license that they use for their funding. It's been a very good arbitrage on the funding side, but it's also presenting quite a lot of challenges. A bank is quite expensive to run, so you need to have a pretty substantial business on the NPL side in order to support the running of a bank.
The point you make is absolutely correct, that there's, again, a dynamic between having this, call it cheap funding, but also being under regulatory scrutiny and control. You may recall that one of the issues when the Get Back scandal occurred in Poland, Hoist had some issues buying into the assets there, exactly because of what you said, because of the regulatory scrutiny.
It opens up quite a lot of questions here. I mean, we can discuss this for a very long time, but I think that in the way that you're taking a pool of non-performing assets and you're repackaging this into something and putting on a new forecast based on a new purchase price, and then you're treating it as basically a performing asset for the bank that you then can use for the funding. I think that's a little bit of a stretch. The regulators obviously accept this, but I know that in Germany this has been questioned by the regulators when the banks have been doing this.
Well, to be fair, it's to some extent the underpinning of the entire NPL securitization market, that and state guarantees. Another point that you raised that's very interesting is about the private equity approach. Looking at the market, again, as we said earlier, the pure NPL market in Central and Eastern Europe had started to contract somewhat in the last couple of years, simply because the product had been sold. And what we were seeing was a movement into a private equity turnaround approach. Some of the traditional big players, AOS, APS, B2, DDM, Intrum, various other ones, they have the infrastructure, they understand underwriting. So the issue then was, if we can do it for a portfolio, why not do it for single names as a private equity turnaround? Is this something that you've seen in the market, and is this something that you would be considering with Laub?
We certainly have the expertise in order to do corporate turnarounds. What you said, I don't know if I fully agree with that. I know that there's been a lot of focus on single names, but I think most of the efforts that are done with single names is a matter of recovering as much as you can from that loan. I don't know how many true corporate turnarounds we've seen, in the sense that you're looking to break something apart and then refine a component of that and sell it at a higher value. Most of the investors that we're looking at, certainly most of the ones that you mentioned, are investors that are looking at cash. They're not looking at, let's buy a bank, let's split out parts that are non-core, and then we can re-IPO this or something like this, which would be the pure private equity approach. The private equity type structuring is something that we like quite a lot. And I mean, that's also a significant difference with Laub, in that we've chosen private equity type funding mechanism where we have drawdowns that we can make from the investor commitments. And this is very important as a differentiator, I think, in the business model on the funding side, as compared to being a listed company where you have to issue shares or take in share capital and then combine that with issuing bonds on the debt side of the financing. Of course, if you print a bond, you never know where the bond market is open, so you have to do it in advance. That means that you're, in a sense, bleeding interest without necessarily having the money invested and generating income on the other side, which is certainly a challenge in that model. The Laub structure that we've established for our investors, we think that we will bleed out less money, if you will, meaning that we can return better returns back to our investors.
Very interesting. Can you still maintain a certain nimbleness in the market without kind of a war chest?
Absolutely. You need to evidence that you have funding, of course, when you go into the transactions. By and large, people don't, or the selling sides don't have an issue with taking the commitments that you have from investors as proof of funding.
Going back to one of your earlier comments as well, I very much enjoy that you opened with Ukraine, because that part of the world has always been fascinating, yet somehow impenetrable. Since you have a very large geographic footprint, where did you see the key markets? What are we calling it before Corona? And where do you see the key markets post-Corona?
I think, unfortunately, it's so that the weaker economies will be more hit than the stronger economies. The countries that did a sterling job in the cleanup after the financial crisis will come out better or faster out of this crisis than certain other countries. Unfortunately, now we're talking about one of the countries in Europe that will have the biggest impact will be Greece, and which is very unfortunate for the Greek economy, of course, given that they haven't managed to really empty their books out of the non-performing assets since the last crisis even. Same thing goes, of course, with Italy. I mean, on the other hand, we have some of the bright stars in the Eastern European or Central European markets, such as Slovenia or Czech Republic, Slovakia. They did their homework and they cleaned up very well after the last crisis, and there we will have relatively less problems. But that said, this is a crisis in the real economy that affects everybody, meaning that we will have soaring unemployment in basically all countries across Europe. And that in itself will lead to credit losses and the unfortunate situation where people and companies are not able to meet their responsibilities. It's inevitable that we will have higher NPL ratios in basically all countries. The only question is how much they will rise in these different countries. I think there's also a big thing that happened, of course, after financial crisis, which varies from market to market, is that many of the multinational banks, they pulled out of some of the smaller countries, consolidated back to their home countries. We saw this with some of the UK banks, RBS, for example, that pulled back from many markets. We had, GE, of course, that became other banks in certain markets, but they're certainly not there as lenders anymore. In the G capacity, there's numbers of examples of this.
In our neighborhood, of course, the Greek banks have retracted back to Greece. Yeah. So they were very active in Serbia, Bulgaria, Romania. So you're absolutely correct.
But they still hold large portfolios of NPLs in many of these countries. That's yeah. Because they haven't managed to sell these things, so they didn't want to sell them, or I don't know what. But now, of course, they're not generating maybe new NPLs, but they're certainly, it's not helping, right?
The equity goes, but the debt always outlives you. That's always the case.
Exactly.
That's always the case. Yes. You make an interesting observation about Greece and Italy. Of course, we all know that both Italy and Spain have been very hard hit by Corona from a medical perspective. And of course, that will have a knock-on effect on their economies. Interestingly, Greece has not been that hard hit, and in fact was really emerging from its crisis quite solidly, helped very much by the entire Hercules state-guaranteed NPL securitization program. And the fact that, going back to one of your earlier comments, a lot of the big players, the diversified large players, were very interested in Greece because the portfolios were enormous. You have more or less the same resources, the same amount of labor, and you just get a lot more, as I say, bang for your buck. How do you see the whole business going forward in Italy and Greece, for instance, where so much of the momentum was because of the state guarantees? Will the state be able to support those guarantees now, and will investors give those guarantees the weight that they previously did?
I think from the offset, I'm not banking on any of these countries, going into default, right? That's for one. Apart from that, I guess it's important here to put things in perspective. I think, as you said, Greece is not been that hard hit from the coronavirus itself in terms of, people getting sick and dying and so. But the hit to the real economy is going to be massive. They will lose the entire holiday season of 2020, for one. there probably won't be any people there. Same thing for Croatia, Italy. I mean, even here in Spain, down here in Andalusia, we have 95% of the economy is standing still, basically, which is terrible. If I can draw the parallel to the Spanish numbers, they're talking, according to the World Bank and the IFC, I mean, we're talking about an 8.5% drop in GDP for this year in Spain. So this is over a 3-quarter period. And it's basically the same drop in GDP that Spain saw over a 3-year period in the financial crisis. So the economy is hitting a brick wall very, very fast here, and it's going to be very painful. And then if they say that the GDP is going down even more in Greece, I don't even know what that translates into. But